Everyone's heard the advice. Just buy real estate, and over time, you'll build long-term wealth. But here's the thing. If you're just buying any property and hoping for equity growth and principal pay down, you're leaving a lot of money on the table. Today, I'm going to show you how to achieve higher returns on your real estate portfolio by making smarter strategic decisions. Whether you're aiming for 10% returns or more, I'll guide you through how to get there. If you're an investor, this is a video for you. So what do most people do? They buy a property, they rent it out, and they wait for it to appreciate over time. Sure, over time, you're going to see 6% equity growth on leveraged money, but that's just playing the long game. You could be doing so much more. Let me break it down. By simply buying and holding, you're likely seeing principal pay down and equity appreciation. There's no doubt about that. But the real key to higher returns is in buying strategically. And that all starts with understanding your investment style. Ask yourself a simple question. Are you a cash flow investor or an equity investor? It all starts with that to understanding how to position your investments going forward. If you're a cash flow investor, you're probably looking at something that's going to feed you passive income every single month. It could be something like an Airbnb or multifamily. Those can give you great returns, but only if done right. We're going to look at those numbers shortly. On the other hand, if you're more of an equity investor, you're likely chasing appreciation and bigger paydays down the road. Assignments or fix and flip deals could be your sweet spot. Now, if you're a cash flow investor, here's how you can increase your returns. If you're looking at long-term rentals as an example for a condo in Toronto, today at this point in time, we're looking at about $2,100 for a one-bedroom unit on a long-term rental. Now, the way you can increase that return is going towards a short-term rental. Short-term rentals should bring you on average about $5,000 to $6,000 a month. Now, there are some rules around that, but that's what it should bring you to increase your monthly cash flows. Why? Simple. Higher nightly rent, a flexibility with bookings, and also a big demand in big cities for short-term stay. Of course, it comes with added management and guest management, but the returns you could be receiving could more than make up for that. Just like what I said before, a one-bedroom and a long-term rental will bring you about $24,000 in annual revenue on that apartment. A short-term rental, which is about $5,000 a month, would bring you about $60,000 in annual revenue. Some property management companies being able to achieve higher than $70,000 or $80,000 in annual revenue if they have a corporate rental program in place. That's a huge jump in cash flows. Now, for equity investors out there, equity investors, you always got to look at the current landscape. There's always parts of the market that are depressed, people are in pain, that you can also capitalize on. In today's market, we're seeing a lot of opportunity today in assignments. These are people who over-leverage themselves, of course, on pre-construction properties. They bought 2, 3, 4, 5 units or even more, and they do not have the ability to close. So an equity investor is always looking at opportunity in the marketplace. And in today's market, that's where we're seeing the opportunity. You could be buying deals that are 5, 10, 15%, even 20% that are under market value. And if you're an equity investor and it's something that you want to buy and you want to flip, then at least you have about 15 to 20% in built-in equity into that property in case the market comes a little bit lower or whatever it may be. Now, when you're investing in equities, of course, it's a riskier game and you have to know what you're doing. If you really know what you're doing and you really understand the values, then it's a lot easier for you to spot the opportunity in a deal. And it takes you about 30 seconds to a minute to underwrite a deal in your brain before you say, I want to offer on it or not. 10% of deals may make sense to buy, and that's something that you have to have the knowledge, or you have to build a team to tell you what makes sense and what doesn't make sense, and making sure that your team is understanding that you are looking for a buy and a flip. Now, whether you're a cash flow investor or an equity investor, here is the part that most investors, they overlook. They're looking for the perfect timing. The perfect timing in the general public's view is typically when everybody's jumping back into the marketplace. That is obviously not the perfect timing. The perfect timing is the time that nobody's jumping into the marketplace. You have to have the knowledge and understand the market that you're investing in. If you're bullish on the market long term, you know it's going to come back up. And when the market is lower, you're buying and seeking those opportunities from distressed sellers so that you can have that gain over the few years afterwards, given that you're bullish on the marketplace. If you're a cash flow investor, the one thing that you got to look at with waiting to time the market is if you cannot find a deal right now that cash flows to the metrics that you're looking for, then I understand wait. But every big time real estate investor in general, they're never betting on the marketplace that, oh, the market's going to be better in 6 months from now or 12 months from now or 2 years from now. The biggest investors are buying in a down market. They're also buying in an up market because they have certain metrics that they follow. And as long as the numbers on that deal make sense according to their spreadsheets, then they'll pull the trigger on it. And that's what you have to look for. You have to make sure that you have a certain target of what you're trying to achieve as a cash flow investor. And then as long as you achieve that target, then you're able to pull the trigger on that property. If you're an equity investor, it's a little bit of a different story. The reason why it's a little bit of a different story is because you're betting on flipping that kind of product in the next 6 months, 12 months, or 2 years, or whatever it may be. So if markets are coming up and down 5, 10%, 15%, that could already be your margin. So as an equity investor, you really want to understand the overall landscape, the best time to get in, because that 10 or 15% margin could be wiped out clean if the market turns on you. Now look, real estate is complex. There's a lot of little different nitty-gritty stuff in real estate that to achieve your average 6% return, you have to make sure you have a team. Now, your team consists of your mortgage broker, lawyers that you work with, your real estate broker that you work with. The real estate broker is going to bring you deals that you could potentially see on market or that you cannot even see because they're all off market products. Your mortgage broker is going to make sure that he's shopping around for the best rates for you, because that margin that you've got on a real estate buy and flip, as an example, if you're an equity investor, you need to make sure that you're getting, as an example, a variable mortgage as opposed to a fixed mortgage. Because if you're flipping something, you don't want to be locked into a 3-year fix and have to pay penalties to the bank. And the lawyer is going to make sure that the offer that you put into place, the closing, and so on and so forth, all of that is taken care of to make sure that you have a very smooth closing and there are no hiccups. If you're serious about building long-term wealth, think of real estate as an avenue, but also think of real estate as you can either go very good and have very good returns, or you can have average returns, or on the flip side, you can also lose a lot of money. Make sure you have the proper professionals in your corner, build that team, and get on your real estate journey to scale that portfolio to build long-term wealth for you and your family.